Good morning, everyone. I'm Pranali, your host for today. I welcome each and everyone for today's Sadgun Summit. This is our 284th virtual webinar. Topic for today is insurance industry, which shall be taken by Mr. Ravi Krishnamurthy, sir. Agenda for the Sadgun Summit, particulars, virtual inauguration by Dr. Sundar Kataria, invoking the blessing of Deity chanting of Gayatri Mantra, introduction of speaker, presentation by Mr. Ravi Krishnamurthy sir, question and answer session, closing session. Dr. Sundar Kataria, Chairman and Managing Director of ICS Group Companies, Sadgun Sangh conceived and led by Dr. Sundar Kataria, driven with a mission to elevate the quality, safety, and environmental awareness levels of industry. Sadgun Sangh is a series of educative, informative events aiming to illuminate professionals on possible solutions to current issues of industry and economy. Sundar Sir's designation and organization, Chairman and Managing Director of International Certification Services Private Limited, Academic Qualification, Mechanical Engineering, Honorary Doctorate, Business Management, Experience, Nuclear Lab. He started his career in building India's first nuclear power plant at Rawatbhatta, Kota, Rajasthan. Oil and Gas EIL. He contributed in developing India's first oil and gas field at Bombay High since its inception. DNV, he was a head of industry and offshore development with DNV for 2 decades. ICS, he is a founder of a first Indian conformity assessment and inspection body known as International Certification Services Private Limited, which is a provider of a total quality solution under single umbrella with a wide spectrum of services. Achievements and awards. Lifetime Achievement Award of NACE Corcon, received several national and international awards. Now I request Dr. Sundar Kataria sir to virtually inaugurate today's session.
शुभं कुरुत्वं कल्याणम् आरोग्यं धनसम्पदः शत्रुबुद्धिविनाशाय दीपज्योतिर्नमोऽस्तुते दीपज्योतिर्नमोऽस्तुते शुभं कुरुत्वं कल्याणम् आरोग्यं धनसम्पदः शुभं कुरुत्वं कल्याणम् आरोग्यं धनसम्पदः.
Please join us for the recitation of the Gayatri Mantra. Introduction of the keynote speaker. Mr. Ravi Krishnamurthy sir, designation and organization, trustee of Karuna Seva, an NGO working in the social sector across Mumbai and Maharashtra, retired president from SBI Life Insurance, volunteer with Isha Foundation, academic qualification, diploma in HR from NMIMS in 2004, business excellence program from Columbia Business School, fellow member of Institute of Directors, accredited with Indian Institute of Corporate Affairs, certified qualities from CustomerPro, achievements and awards, led SBI Life Insurance in winning the prestigious Ramakrishna Bajaj National Quality Award twice, contributed to winning the Asia Pacific Quality Award, accredited RB&QA examiner, guiding corporates on quality and sustainable governance frameworks, played a key leadership role in growing SBI Life market share from 2% rupees 250 crore to 20% rupees 81,500 crore. Expertise in marketing, process excellence, technology, risk management, services, leadership transformation. Experience around 40 plus years of professional experience, 2 decades in banking, 2 decades in insurance industry, State Bank of India, retail banking and corporate lending from 1983 to 1994, ICICI Bank, business strategy, marketing and process excellence 1994 to 2004, SBI Life Insurance, president, leadership in marketing, technology, risk and transformation from 2004 to 2024. Welcome, Mr. Ravi, sir. Over to you, sir. You can unmute yourself and video and talk.
Yeah, I hope you can hear me.
Yes, sir. I can hear.
Okay, I can start off. Pranali, thank you very much for the introduction. And I spent about 2 decades in the life insurance industry. So therefore, I thought I should give you some kind of understanding about this sector. And what I will do today is to give you an understanding of the sector and particularly about the types of products in the insurance sector and the industry as such and the perspectives going forward. What are the risk management practices that one should be aware of when you approach this life insurance sector? I think a lot of you people are also auditors. So when you come as an auditor, you must understand the risk management perspective of this industry also. So you can host the presentation, Pranali, without any further delay.
1 second or so. Yes, sir, it's shared.
Okay. So this is the life insurance market that I will give you an understanding, the growth trajectory and the opportunities going forward. Some understanding of the types of products, some understanding about the risk management practices, and what actually constitutes the life insurance industry from an outsider's point of view, whether you are an investor in the stock market, whether you're an auditor, or whether you're a customer. So 3 areas: customer, investor, and auditor. All the 3 angles, I think you will get a very good idea in today's presentation. Over to you, Pranali. Next slide. So this life insurance sector, if you look at the perspective of the need for the life insurance sector, you'll find that almost 54% people are between the age of 25 to 64 years. This is the composition of the population. Also, you will see that the growth of the population above 65 years is also growing. If you see from 2026 to 2056, as we go along, you'll find that in the future, this sector of age of 65 plus will grow. The age of 25 to 64 will continue to be more or less 54-55% because of the constant birth of new generation and also the aging of the population. This is very important for you to understand because what are we trying to ensure? We are trying to ensure the growing sector of youngsters who are entering the employment between age of 25 to 64 years, and the people who are entering into retirement. These are the two population that we are trying to insure today. And therefore, today we will be discussing two types of products. One is life insurance products, other is the annuity products. Now, life insurance penetration, if you look at it, India is, in terms of penetration, premium as a percentage of GDP, if you look at it, we are quite low. We are now almost 3% of the GDP. China is 2% of the GDP, but we must remember that China has a much higher GDP than us. So if you look at it, there is huge scope for life insurance penetration. There is also a lot of under penetration in the market. That means lots and lots of Indians have yet to get an insurance product. And the third graph which you're seeing is the life insurance density, which is, for example, to read the slide, $6,264 per person is the average premium that a Singaporean customer or a Singaporean citizen has. Compare it with India, we are just $70 to the GDP. So we are very, very underinsured market. And therefore, there is huge potential for it. You might have seen in the news that there is a lot of government is inviting foreign players into this industry. They are inviting lot of domestic sector players also into the industry because the scope is so high. And why is the government doing that? The government is doing that because any developed nation, like Singapore, for example, if you see, it's an indication of development. An insured population is an important indicator of development. Let's go to the next slide. Now we go to the next slide. India is still, as I mentioned, under-penetrated insurance market. So if you look at it, the protection gap, what do you mean by protection? Life insurance protection. So if you look at that gap, India is the highest among peers. So if you compare with Thailand, you compare with China, you compare with Singapore, or you compare with South Korea, look at the gap. 83% is the gap highest among peers. The second part is the sum assured. What is sum assured? The total insurance taken. Total insurance taken, matlab, suppose you have taken a premium of, you have paid a premium of say 10,000 rupees. You have covered yourself for a sum assured of 2 lakhs, which means what? That if somebody dies, he'll get a insurance of 2 lakhs. That is what I mean by sum assured. Sum assured in insurance terminology means total life cover, to be very, very simple. Now, sum assured as a percentage of GDP, you look at India, still very, very low. So therefore, if you are growing in GDP, correspondingly, sum assured also has to grow. Correspondingly, life cover taken also has to grow. Only then we can call ourselves truly as a developed nation. So as a developed nation, it is parallelly required that as we develop, the sum assured as a percentage of GDP also grows. Now you look at the right-hand side, retail loans. Retail loans from 12 trillion in 2012 is gone to 53 trillion, which means more and more personal loan segment, housing loan segment, consumer loan segment is growing. Now, as the loans grow, what happens? If a customer who has taken a loan defaults or he dies, the whole family suffers. They have to literally take out everything to pay back the loan. Let us assume he has taken a housing loan and the person dies. What will happen to the family? The family has to repay the loan. Whereas if that person had taken a life cover, the entire life cover payment after death will go towards the housing loan payment. So why I'm saying this, the retail loans are growing. It is therefore needed commensurately that insurance also grows. Because if insurance doesn't grow, all these loans are undercovered. And a citizen of the country taking a loan without cover, without insurance cover, is very dangerous for the country because let us assume 1 trillion people have taken retail loans and all of them default. There is a major earthquake, something happens. You can look at the amount of default. Bankers will have non-performing assets. Citizens' families will go for a toss. They will be ending up selling their entire assets only to repay the housing loan in order to safeguard the housing loan. Next slide, please. Now look at the other side. The other side is the annuity solutions. As I mentioned in the first slide, one is the younger population. 55% of the total composition of our age group will be between 25 to 55. But at the same time, there is a population which was born, say, in 75, 80, 85, which is aging. Now, what happens when people age? There is another risk, and that risk is the retirement risk, longevity risk. So when people retire today and they get a provident fund money, let's say they get a provident fund money of say 2 crores. What do? They have to get pension every month. Now today there is no pension scheme of the government. All banks, everybody has given up on pension. So therefore they have to get some pension out of that PF money. What will they do? They have to invest it in a annuity product. Annuity is nothing but pension product. So they have to invest it in a pension product and then get monthly pension. So some of these pension products will give monthly pension when you deposit the entire money. And that is why for retirement bliss, we don't know whether the person will live till 65, whether he live till 80, 90. As health improves, health standards improve in the country, medical benefits improve in the country, people will live longer. So when people live longer, they will need pension for a longer time. Let us say the person lives up to 90. So the entire money of Provident Fund, if he deposits simply in a bank, he doesn't know with the inflation what will happen to that money. A bank will give you a 5-year deposit. It will give you a 7-year deposit. It cannot give a 50-year fixed deposit. So therefore, you need a product where the person puts the money today and for the next 40 years, for example, from 50 to 90 years, he must keep getting pension every month. So that is why annuity solutions are very, very important for retirement benefits. And that is why you can see here that the pension assets to GDP ratio is very less. People are not investing in such products and therefore they're losing out. And let me give you an example. Today, for example, bank fixed deposit rate of interest is 6%. But bank is giving you only for 5 years. Now, can I get 6% and tie it up and firm it up for 30 years? You can, provided, say, you invest in an annuity product. Let us say you invest in LIC's annuity product. LIC may give you a return of 6% for 30 years. Whereas a bank can give you a return of 5 years. After 5 years, the interest rate may drop. Whereas I want to tie up the interest rate permanently. So that is why there is huge population for the huge potential for scope of annuity business. The second graph, if you see, from 2022, 10.5% of aging population. In 2050, we expect it to be about 20.8%. 20.8% of the population will be aging. That will be the percentage of aging population, 60 plus. And life expectancy, if you see, from 17 to 18, it will grow to 20 to 22%, which means the life expectancy is going to increase. So as it increases, you need to cover your uncertainty. You need to be able to look to live longer and longer. If you live longer and longer, the risk is higher because you don't have money to give you pension for the next 25 years. And that is why annuity market is a very big market. I want to say in these 4 slides that there is market for life cover, there is market for annuity cover, or let me say simply pension cover. So there is huge market in this country for both life cover and pension cover. And that is why this industry topic I took up today, because this is going to be fundamentally the marathon runner close to the GDP. As the economy grows, this sector also has to grow. If people are not covered for life, if people are not covered for pension, then you imagine what will happen to the income earning potential of the people. Once a person retires, his income earning potential is gone. So whatever he saves through retirement product is what is going to help him. So at this point of time, friends, you remember 2 concepts: market for life insurance products, market for retirement products. You remember that I can buy life insurance cover if I am 30 years, 45 years, 50 years. And if I am above 60, I should buy a retirement product. These two things as a customer you understand, as an investor you understand, as an auditor you must understand. When you go to any company to audit, when you go to any company as a customer, there are two types of products broadly which insurance sector is selling. One is life cover, another is retirement cover. Next slide, Pranavi. Now, India's financial evolution. This is general topic, but you must understand how this GDP is growing. We are the fastest growing economy. Now, this is not to boast. What is really required is, are we covering our population with insurance products and annuity products or not? That is important. If we are not covering, then this growth is of no use because you'll have a whole uncovered population. So, for example, I told you that if you pay 10,000 rupees premium and the sum assured or the total life cover is say 3 lakhs, imagine if people die, the economy will have to foot. The government will have to foot out 3 lakhs, 5 lakhs. Whereas if the person has taken a cover, the life insurance industry will give that money. The other part is household savings. Now you see one very disturbing aspect. From financial year 21 to financial year 24, the physical savings is increasing corresponding to financial savings. Physical savings means what? Gold, house property, corresponding to instruments like savings bank, fixed deposit, life insurance cover. So this is not a good sign. But I think in this graph, this 28% is net financial savings. Net matlab savings minus loans. So that means the loans are increasing. People are taking more and more loans, which is a good thing because they are taking loans to cover their housing loan. They are taking loans for their education, children's education. But then in that case, there is no point in investing in gold to cover that. There is more liquid instruments like a life cover or annuity product in which they should enter. Last graph is share of life insurance in financial savings. Now look at this closely. Life insurance is still not a very major part. Life insurance and pension, if you look at it, both are not such a major part. If you take pension and life insurance together, it is about 22 plus 15, 37. 37% of life insurance is the share of life insurance in financial savings. Almost 7 plus 15 plus 6 is still in other forms of deposits. So 35 plus 6, 41, 41, almost more than 60% is still investing in other forms of deposit, other forms of investments like shares, deposits, currency, gold, etc. By itself, it is a savings is a good habit of individuals, no problem. But it is not a good sign because you're not preparing your customer or the citizen for the future. Both life and pension products prepare people for the future. Now, next slide. Now, this is an important slide. I will give you 3-4 very important definitions and 3 or 4 very important things. One is this life insurance sector has got 2 types of products. 2 types of products, matlab, one is, I think it has gone into Pranali, this has gone, go back to the previous slide. There are 2 types of products, unit linked products and traditional products. You remember this only now, only remember this. As I go in the next slides, I will give you a better understanding of these products. One is unit linked product, another is traditional product. Unit linked product is stock market linked. Okay. Traditional products are non-stock market. Okay. Now, in the industry, if you look at it, ULIP products are very, very less, just 19%, and almost 81% is traditional. Why? You know that the industry's major shareholder, major person, major company which is selling life insurance is the Life Insurance Corporation of India. Now, Life Insurance Corporation of India majorly sells traditional product. They sell very little unit linked product. That is why The industry graph, if you look at it, 81% is traditional, 19% is unit linked. You must have, I'll give you one example of traditional. All of you are very familiar with the life insurance agent, the LIC agent. What is the most common product that you think of? Money back policy. You think of the money back policy, survival benefit policy. Now, this policy, if you look at it, is a traditional policy. It does not invest in stock market directly your savings. The overall investment may be going into the stock market, maybe going into various bonds, debentures. But if you look at money back policy, it doesn't fluctuate. It doesn't fluctuate with the stock market. It is a simple product, traditional product, where if you whatever premium you are paying goes into a common pool. It goes into a common pool, and whatever profit LIC makes, 95% of it or 90% of it is distributed back to you. This you must remember. Unit linked is not like that. As a company, I don't take any responsibility for your investment. You are investing in the market, it is your responsibility, so you get the benefit. Both ULIP and traditional have risk cover. It's not just savings. It has got risk cover. If there is a death, the sum assured is paid. Now let me come to private players. In private players, if you look at it, the traditional product is more. The ULIP product is higher and the traditional product is slightly less. As against 81% of the industry, private players, it is 64%. Now let me give you, LIC is the only life insurance player in the public sector. Private sector has got so many players, almost 18, 19 players, of which about, if you look at it, about 7 or 8 are very major private players. Like, for example, leading the pack is SBI Life. Then you have ICICI Prudential. Then you have HDFC Life. Then Birla Sun Life. Then so on. Bajaj Life Insurance Company. These are private life insurance companies. LIC is the giant, which is a public sector life insurance company. And all these private players sell more unit linked, less traditional. Why? Because I think historically, LIC sold money back policies and traditional policies. Customers were given more surety. Customers played safe and customers were told to play safe. So they went only with traditional policies. Modern private players have younger customers. They are more Gen Z customers. So therefore, they go for taking risk. This much you understand right now. As the slides go, I will give you more understanding of ULIP and traditional. Right-hand side of this graph, how do insurance companies sell? Now, insurance companies sell through 3-4 methods. The most common method is what you see, the life insurance agent who comes to your doorstep. Most familiar person from LIC. This is from more than 50 years. LIC has adopted the agency model. You can see that color, agency, which is about industry. 49% of today's life insurance products being sold is sold through the typical traditional agency model, where people take a LIC agency and they go and sell going to the customer's house. Now, almost 33%, which is growing from financial year 21, 29% to financial year 25, 33%. 33% of industry's life insurance is sold at the bank branch. So when you get into the bank branch, when you go to the bank branch, a pitch is made to buy a life insurance product. Okay. Now this is a new channel which has come after the entry of the private sector. So if you go to State Bank of India, you go to ICICI Bank, you go to HDFC Bank, people will pitch you a life insurance policy. And this is a very convenient method of pitching a policy because it is very easy to buy, it's very easy to sell. Bank branch is a very trusted partner of the customer. So it is very easy to buy. That is why industry has also, go back to the previous slide, I have not completed. That is why industry also is promoting bank assurance channel. Obviously, in private players, the use of the bank assurance channel is higher. Why? Friends, agency channel takes long time to develop. It has taken 50 years for LIC to build an agency model. Because you know why? LIC agent goes from house to house, society to society, markets. It's a very difficult way, but it's a very trusted way of selling. So it takes long time to materialize. Private players have come only from 2001, only 25 years since the private players came. So when private players came, they adopted the banca channel. So because it is easy to sell, easy to grow, and that is why you can see that banca channel continues to be the largest contributor for private players. The third channel is the direct channel. Direct channel is one example I'll give you, Policy Bazaar. You go to the internet, buy a policy, or you go directly to a life insurance company, go to the office of a life insurance company and buy the product directly from the employee without an agent or a bank branch involved in the intermediation, which means you get the policy directly from the LIC or LIC or anybody else, because these people, then what happens is there is no commission paid to the agent or to the bank, which case the product becomes a little cheaper. Now let's go to the next slide. So I have told you about two types of products, traditional product, unit link product. Now let us go to the next slide. I think you are going on your slides very fast, Pranali. Go back. Go
Hold
back.
on, sir. Yes.
No, you have to go back.
Yeah.
One more slide. You stop here. No.
Yes.
Stop here.
Yes.
Now here I am first introducing one type of traditional product. One type of traditional product, matlab, which is called participating product, which is very commonly called par product. If you are going to audit the insurance company or you are going to buy a product from an agent, remember this. Even in the investor presentations, you will find par product. Par means participating product. What is participating product? There are three components of that product. One, you will get a life cover. Okay. Second is there is a savings. Now I'll tell you why these kind of products have come. Very interesting. In West, that is, I'm saying America, Europe, people fear death. So they take life cover only. They don't take savings. They go for savings to other products. They buy in stock market, they buy mutual funds, they buy savings deposit, other. But in the West, they fear death, so they take only life cover products. In India, typical mindset is, if I die, my family will get life cover. But what if I don't die? Then all the premium I have paid is gone waste. That is why the origin of participating product, where I want to have the best of both the worlds. So life cover plus savings plus bonus. Three components are there. Bonus is nothing but, I can say, interest. Okay, earnings. So I gave you premium, that became a saving. Some part of the saving went to create a pool for life cover. In case I die, I will get life cover or sum assured or whatever you call it. Third component is this savings will multiply by my investing in a safe market, not in equity market. Generally, par funds are invested in bonds, debentures, safe funds. And the earnings out of that is what is called bonus. Now, bonus is not guaranteed. It's not that bonus has to be paid. But if I make 100 rupees profit, 95 rupees will have to be necessarily paid back to the investor, to the customer. So three components, there is life cover in case of death. In case I don't die, there is savings component which will be returned back to me. And the third component is not only the savings will be returned back to me, a part of the interest earned, a good part, 95% of the interest earned out of the pool will be paid back to me as bonus. There are four types of bonuses that are paid. One is reversionary bonus. What is reversionary bonus? Reversionary bonus means at the end of the maturity, every year a bonus is declared and it is accumulating into your savings, and at the end of maturity it is paid back. Second is interim bonus. Interim bonus is, interim dividend in stock. In the middle of the year, they may declare an interim bonus. Third is after declaring reversionary bonus annually every year, at the end of maturity, a terminal bonus may be paid. All these three, reversionary, interest, reversionary, interim, terminal, are all not paid to you by credit to your account. They are all paid to the pool, your pool, and it is accumulated. And all this is paid to you at the end of the maturity. Cash bonus is different. Cash bonus means I declare a bonus at the end of this year and I straight away credit to your account, your savings bank account. Whereas all the other three bonuses are invested into your deposit, the premium that is accumulated, and that continues to accumulate. So there are four types of bonuses. So insurer profits through bonus mechanism, and it is a disciplined savings mechanism. So par products is a disciplined savings mechanism because every year you pay premium. Sometimes you may pay every quarter premium. Sometimes you may pay every month premium. So monthly premium, quarterly premium, annual premium, half-yearly premium. And discipline in par products is all these products are for 10 years, 15 years, 20 years. Why? Because these products are by nature long-term. Because your life insurance company invests in long-term instruments. They invest in long-term savings instruments. So generally, par products are sold by agents of the company. When you are young, I remember when I took a par money back policy at the age of 25. When I took a job, the first thing I did was I took a par policy. I got terminal benefits, survival benefits, I got cash bonus, I got interim bonus, reversion bonus at the end of maturity at 45 or 50 years. I kept on paying. So it's a very disciplined savings method. Once a bonus is declared, it is guaranteed. It cannot be taken back. Okay, so every year the life insurance company assesses the pool of all the customers who have taken par policies. Let us say 1,000 customers took a par policy. All the 1,000 customers' money is put into a single pool, and that pool is invested. At the end of the year, the life insurance company assesses the pool's profit, and out of the profit, 95% is distributed back in the form of either reversionary bonus, or sometimes in the middle of the year, they may assess and give an interim bonus. Sometimes they may give at the end of the maturity some additional bonus, and then sometimes in between they can simply give a cash bonus and credit your account directly. So that is why these products are very, very oldest life insurance company products in India. Go to the next slide, Pranali. Now the second type of traditional products is what is called the non-participating products. What is non-participating? Non-participating means these are guaranteed interest rate products. Guaranteed interest rate matlab the life insurance company may earn 8% out of the pool, but they may not give you 8% because I have guaranteed you 6%. Or the life insurance company may earn only 2% out of the pool. They may only earn 2%, but still they have to give you what is guaranteed by them. So it works both sides. So these are non-participating products, are fixed guaranteed products. It is very ideal for customers who are seeking certainty. In the previous slide, you saw participating products where customers are not given any certainty. If I make profits, 95% is yours. If I don't make enough profits, the bonus is less. Bonus can be high or less. There is no fixed sum assured, fixed maturity benefit. But it is safe because investment is in safe instrument, but it is not necessarily fixed. Non-participating product is another form of traditional products where the return is guaranteed. The return is guaranteed, the rate of interest is declared upfront, and there is a defined payout at the end of the year. These products also can be for 5 years, 10 years, 15 years. Go to the next slide. Now, the third types of product, I'm shifting from life cover to annuity products, retirement products. Okay, so I have not yet got into unit link product yet. I'm still developing my lecture today on traditional products, which is two types: participating product, non-participating products. And the third is the annuity product. Annuity means, don't get confused with terminology. Annuity means simply pension. Okay. Now, this pension products you can contribute you can contribute as regular premium every month, every year. From say at the age of 45, you start preparing for your pension. So for 15 years, you may pay annually premium, and from the 60th year, you may start getting pension. This is one variety. Another variety is you got provident fund money at the age of 60, and the entire lump sum you put it into annuity product, and from day one you are starting to get pension. So the first variety is deferred pension. I start investing from 45 years, I get pension from 60 years. This is called deferred pension. I get immediate pension. Immediate pension matlab I put my money as a single premium and I started getting immediately. So typically immediate annuity plans are single premium plans. And deferred premium plans are regular premium products because you start planning for your pension. So regular premium products are retirement corpuses, and they can give you, mostly these are all products where they give you a guaranteed income because the rate of interest is upfront declared. Now let me tell you what is this rate of interest being declared upfront. Suppose the going, say, money market rate is say 6%. They will come with a product, a scheme, where they'll say, I'm giving you 6%. Now, this 6% is guaranteed for you till the age of 90, as long as you live, irrespective of whether the interest rates are sliding or they are growing up. So, let us assume all developed nations, the interest rate starts sliding. So, the interest rate is sliding. You are benefiting because you put your money in a product where your interest rate is frozen. So, for example, I put money at the age of 50. Say every year I invested, say, 3 lakhs. At the age of 60, I'll start getting pension, say monthly pension. I'm giving you a rough estimate. I'll start getting, say, 25,000 rupees per month pension, depending on the total corpus premium you have paid and the interest rate that has been guaranteed. You will get from 60 years. Now let me complicate this a little bit. This is one person getting pension. Now I'll give you an example. What is called joint life? Now, joint life means me and my wife invested in a pension product, and say at the age of 75, I passed away. My wife will continue to get the pension. There can be many combinations. My wife will get equal pension, my wife may get 50% pension, depending on what product I have chosen. Now, depending on the product that I have chosen, the pension amount to my wife may be higher or lower. So I might have chosen a product where 50% is payable to my wife, in which case the original pension amount payable to me may be higher. Suppose I said equal pension to my wife, the original pension amount may be less. Now joint life, and then the third is very important. Annuity with return of purchase price. So I got pension till 80, I passed away. My wife got pension, she passed away at say 85, and then the entire pool is returned back to my nominees. So the pension is paid out of the interest pool getting accumulated on that pool. And return of purchase price, matlab, at the end of the period, the entire premium that I have paid is returned back to the nominee. Now, suppose you don't opt for return of premium, the pension will be higher. Suppose you opt for return of premium, the pension will be lower. So during my life, if I want higher pension, I may decide I don't want the return of premium at all. I'll keep getting pension. After my death, my wife will get say 100% pension. After my wife's death, nothing will be paid. Everything is closed. In which case, the premium during our lifetime will be higher. The pension during our lifetime will be higher. So these are various varieties. You should not get confused. This is just common sense that if I buy pension with return of premium, my pension will be lower. If I buy pension without return of premium, my pension will be higher. If I buy pension without joint life, then naturally the pension payable to me during my lifetime will be higher. Suppose I go for joint life after my passing away, the joint survivor keeps getting pension. So therefore the pension amount becomes lesser. So there are, one is immediate pension, deferred pension, joint life pension, and annuity with return of purchase price. Now, this is a very difficult product for life insurance companies to manage. because life expectancy is improving, health standards are improving. So more and more people are living longer than our previous generation. So the ability to manage the pool is a very big art in many countries in Europe and all. More pension products are famous because those products are more important to the people. So longevity, risk management, and financial independence is very important. And I would suggest strongly that everybody should go for annuity products, because as we get into our 50s, we must plan our retirement. Next slide. Next slide. Yeah. So here this is, I'm coming to unit link product. So again, to retrace back, I discussed with you traditional product, which is participating, non-participating. Then I discussed with you annuity products, or what you call as pension products. Now, unit link product is the other category. Now, if you notice here, in unit link product, it is similar product to the traditional product with one catch. It is market linked. So you may directly get the benefit of the fund value depending on how the fund value moves. Plus, there is a life cover. So, what is the difference between a mutual fund and a unit link product? A mutual fund is one where there is no life cover. A unit link product is where there is a life cover. It is the one difference. And because there is a life cover, in unit link product, there is a mortality charge. Small charge, but there is a risk cover charge. Mortality charge means risk cover charge. In mutual fund, because there is no life cover, there is no mortality charge. So what does it mean? It means very simple, that if you are a person who doesn't want any life cover, then you should go for a mutual fund, because there is no mortality charge. So the benefit that you'll get out of the accumulation and investment in the stock market will be higher. But because there is a life cover, here you will get a slightly lesser return. But what is more important is, you go to a life insurance company to buy a product for your life cover. You're not going there to buy a return product. If you want returns, you'll go to stock market directly, or you'll go to a mutual fund directly. But here you're coming to a life insurance company because you want to get the benefit of all. I want to cover myself. If I die, my family members should get. At the same time, I want market investment. I want to get the benefit of the stock market growth. And that is why we go for unit link products. And like mutual fund, unit link products also have equity. You can have debt. You can have balanced. You could have liquid. Liquid fund is basically investing in practically fixed deposit. Balanced matlab you are investing in bond and equity in a balanced way. Debt means only in bonds. Equity matlab directly in stock market. So here the dual benefit is life protection, investment growth. On maturity, you will get paid based on the net asset value of the fund, depending on what option you have chosen. Now the premium allocation, the fund selection is all up to you. Accordingly, you will get the market benefit. You understood so far? I am telling you, just to retrace back, we discussed about the potential of the life insurance sector. We discussed about GDP. If the growth of the GDP is growing up, the country needs to go for more and more citizens have to go for life cover. As I mentioned, if there is more and more people don't go for life cover, who will pay for their death? The family members have to pay. That means the family will become poor. See, in order to make sure that the family doesn't get poor, life cover is essential for every citizen. Similarly, annuity product, pension products equally important for them. And in life cover, we discussed traditional products, which is participating, non-participating. Non-participating matlab guaranteed returns. Participating matlab you put it into a pool, 95% return back. There is no certainty of income, but bonuses are paid. And unit link product, I told you about stock market investment or bond investment, debt instrument. Go to the next slide. Now I come to one plan which we never discussed. I mentioned to you earlier that in Western countries, this protection product is the most famous product. Why? Because there, citizens are not, they are not conservative. They like to go for, if I want to go for investment, I go to mutual fund. If I want to take cover, I come to life insurance company. I don't want mix of both. India is different because when I go to life cover insurance company and buy a cover, I want to make sure that if I die, I also get something. My family gets. If I don't die, I also must get something. This mindset is very different in India. That is why India is perhaps one of the very few countries where you see participating, non-participating, and unit-linked products. But in Western countries, protection products are the most famous. Protection product is plain vanilla. It is only life cover. There is no element of savings. No element of savings. If my money is forfeited, if I don't die, my money is paid back if I die. So sum assured is given back if there is death. If there is no death, the entire premium paid is for, it's for ensuring the life cover. Now, because it is a straightforward vanilla product, protection product premiums are very less. They're very less because there is, it's straight, no. Because you forfeit the premium if I don't die, and if I die, the life cover comes to me. So therefore, there is no element of that means there is no element of savings, there is no investment. So the premiums are also lesser, but risks are higher. For example, if I put say 10,000 rupees per annum in a unit linked policy, I may pay a higher premium. But in a protection policy, if I put, I'll pay a lower premium, but the sum assured may be very high. It may be 10 times the premium paid. It can be 20 times the premium paid. So these protection policies, usually you should buy when you are young because there is no disease. Once you get any disease, nobody will offer you protection products. Or if you get older and older, the premiums will become higher and higher. And some companies don't even offer protection products to people who are above 50. And many protection products, the formalities to go through to buy a protection product is long because they are covering you for life, and the sum assured life cover is very high. So therefore, protection products are difficult to buy when you get older. It is difficult to buy when you have medical issues. Now there are still two types of protection products. In India only this is there. In rest of the world this is not there. In rest of the world, it is plain simple. You pay premium. If I die, I get, my family gets. If I don't die, the entire premium is forfeited. But in India, there is term with premium return. So at the end of the term, say 10 years, I took a product policy. At the end of 10 years, I survive the policy. I don't die. The entire premium will be returned back. So because the entire premium is being returned back, the premium will be higher. They'll be charging you a higher premium. But because in the first category, term life, no premium is returned back, it is death or other, the premium will be lesser. So this is exceptionally high coverage at affordable rates, essential for all young families. In some countries, they almost make it mandatory. And in fact, some countries, they make it mandatory for employment. They make it mandatory for housing loan. If you want to take a housing loan, some banks will insist that you must take a term cover because they want to ensure that the housing loan is covered. If something happens to you and the family is completely in despair, at least this will take care, no? So this is very important product. Protection products are become the flavor of the season in all developed countries. And in India, as we develop, as citizens become more aware, people are buying protection products. Government has also come with very small premium mass protection cover products. Pradhan Mantri Jeevan Bima Yojana. This is very small assured, some assured of 50,000 rupees. It is given to all people, and people pay 1,000 rupees per annum or something. These are products which are given without any medical test, without any checking of medical test, only at simple declaration, and they give a Pradhan Mantri Jeevan Bima Yojana cover. So protection policies are very popular in the country, and one second. These protection products are very useful in the country, And this product is extremely useful for people who are taking it at the younger age. After graduation, when you take a job, then people go for these kind of products. Go to the next slide. Now I come to something more important. Uh, don't worry if the presentation is a little heavy. I will again rehearse it at every 2-3 slides. I'll go back. I'll rehearse the whole thing so that you're able to get an idea, because these are abstract subjects for you because you're not from the industry. Now, what is underwriting? Now, if you've seen life insurance policies, not annuity policies, leave annuity policies, just life insurance policies. Life insurance policies carry risk. So I am giving you a policy and I'm carrying certain risk. Now that risk, let us assume 100 people took a life insurance policy. And let us assume that 95% people died. What will happen? The life insurance company will become insolvent, because when you pay me 1,000 rupees premium and I give you, you pay me 1,000 rupees per month premium. So 1,000 rupees into 12,000 into say 5 years, 60,000 rupees. 60,000 rupees premium you pay, and I give you a life cover of say 10 lakhs. What is the basis of my, now you shift, you are suppose the malik of a life insurance company. You forget you are a customer. Now you have become the promoter of a life insurance company. For a customer, I told you all the products, what all benefits you can get. Now you step into the shoes of me as a promoter of life insurance company. I have taken premium from you for 60,000 rupees, and I have given you promised you a life cover of 10 lakhs. Now suppose 100 people came like this, and they took cover like this, 60,000 rupees, 60,000 rupees, everybody paid for 5 years, and they took a life cover of say 10 lakhs. Suppose 95% people died. Then what happens? The total of the premium collected will never be equal to the total life cover, friends. If that were so, if that were so, why should I at all pay you as a life insurance? I'll jolly well put it in my own pocket, no? I'll create a fixed deposit for the amount of life cover I want. Suppose I want a life cover of 10 lakhs. I will create a fixed deposit for 10 lakhs. Why should I come to you? I'm coming to you because the premium is less. I'm coming to you because you collect 60,000 rupees and you give me life cover of 10 lakhs. Now, suppose if everybody took this gamble and came to me and all of them died, I'm gone. So what life insurance companies do is they underwrite the policy. They underwrite the policy, matlab, they assess the risk. Now let me say, I am a healthy person. My friend who's taking a policy is type 2 diabetes. Who's likely to die first? My friend. Let us assume out of the 10 lakhs life cover that all of them took, let us assume 70% people who entered this scheme are all people who had some illness or the other. I am taking policy because मेरे को तो illness है, मेरे को 2 stent लगा था, तो ऐसा सब लोगों ने लिया, everybody took it. Then the company's gone bonkers. So what companies will do is they will underwrite the policy to assess the risk. And based on the assessment of the risk, they may take 3 decisions. One, admit you at standard rate, admit you at substandard rate. Substandard rate means I will charge you extra premium. Let us assume I say that I don't have any health issues, but my father had type 2 diabetes. I may charge you extra premium. Or somebody has come who has done a stent. I may decline the policy. I may not give him at all. And that is why, friends, you must take life insurance policy when you don't need it. When you don't need it, matlab kya? I am healthy. I think nothing will happen to me. That is when you should take the policy. Because when you think, I have this issue, I had that issue, last year I was operated for, say, tuberculosis. I want to take a policy because I'm afraid. No insurance company will give you a policy. Because if they start giving policy to all sick people, then the company is gone. So life insurance companies give policies only to healthy people. But in healthy people, suppose I took a policy today, there is no guarantee that next year I will be healthy. Next year I might contract some major illness. That is what I am covering. That is the risk I am covering. I am covering future risk for a healthy person. I am not covering past risk. Past risk is previous medical. And that is why underwriting is done. Underwriting is to assess the risk of the health of the customer. Now let us see. It is a very responsible job. In a life insurance company, there are people who are underwriters and there are people who are called actuaries. Now, what do actuaries do? They price the product. How do they price the product? They assess what was the previous experience of death in that pool. Then they assess what is the previous experience of death in the industry pool. Based on that, they price the product. Now, let us assume they price the product at, say, 100 rupees. And the death is higher than the assumption. Then what will happen? Next year, they will increase the premium. Next year, they will increase the premium because based on their assumption, they price the product at 100, whereas the actual product happened to be at, actual death were higher than the assumption. That is why there are underwriters who underwrite the policy based on the pricing assumption made by the actuary. This product is priced at this premium, and therefore I do my underwriting assuming that pricing. So underwriters follow the actuary's assumption. They follow the pricing assumption. Go to the next slide. No, there is one slide after this. Now, this slide is very important. You must understand this because when you go as auditors to companies or when you go as ISO standards, you try to assess quality standards. You must understand medical underwriting. Now, there are two types of underwriting. One underwriting is what is called the medical underwriting. Medical underwriting means I ask you to go for a test, and based on the medical test, I assess your health and then I give you a policy. Now, what all assessment is done in medical underwriting? We generally assess 3-4 common things, friends. One is we see with what is your age. If your age is younger, I give you lesser premium. I give you more points if your age is younger. If your health status, if you declare that my health is good, just based on your declaration, or sometimes I may ask you to go for a test to prove your declaration. Sometimes I may ask you to prove your declaration. Sometimes I may go by purely your declaration. So health status, past conditions, past health condition, family history. What is the family history? And lifestyle habits. If I say I'm a smoker, I may be charged a higher premium. If I smoke 4 cigarettes a day, then I may even decline the policy. So basically age, declaration of health, family situation, and lifestyle habits. These are the 4 things based on which medical underwriting is done. Medical underwriting may be done simply based on declaration, or medical underwriting may be done based on medical test done. And friends, this is important. The declaration of health, which is done, is the most important document when you go to a life insurance company and give an application. When you give an application, never sign the application blank. You sign the application after reading what is written on the form, because if you sign it blank and suppose you had some health issue and you didn't disclose it or your agent did not disclose it, your claim may not be paid, because all claim payments in life insurance corporation is based on the veracity of the declaration of facts in the proposal form. What are the facts in the proposal form? Age, income, occupation, health. These 4 factors: age, gender, income, health, age, gender, income, and health status. If these 4 status you are declaring in the proposal form, based on the declaration only they are giving you the proposal, the policy. If at the stage of claim, any of these declarations are found to be false, based on which the company had given you a policy, the claim will be declined. So never sign an application form for life insurance blank. You must insist that I would like to read the policy, and based on the policy declaration, I want to get my premium. If the company doesn't want to give me a policy, so be it. I don't want to waste my premium because later on my family will be denied the claim. So the other type of underwriting, medical underwriting is one part. We do financial underwriting. Why financial underwriting? What is financial underwriting? Now suppose I am a defaulter. I have taken lot of loans and I feel let me take a policy here so that if I die, all loans will be cleared out of the proceeds of the life insurance cover. Very nice idea. Second category of person is I think that I am unemployed, I don't have any income. Let me take a life insurance policy and next day I commit suicide. My family will get a lot of income. That is why generally financial underwriting is to assess whether you are an employed person. Many life insurance policies are given as a life cover is a multiplier of the income. Multiplier in income matlab mera income say 5 lakhs an annum hai, so I may get 12 times. I may get 10 times a life cover. I won't get life cover beyond a particular multiple of the income I earn. Suppose I earn 5 lakhs, I may get 12 times, 10 times, but I won't get 50 times. Why? Because the same argument. Suppose I'm earning 5 lakhs and I think, let me do one clever thing here. Let me take a life cover for 5 crores. And next day, either I commit suicide or I have some health issue and I conquer. My family will get 5 crores. So, financial underwriting is to test, is to verify what is the income you earn. Based on the income, only that amount of sum assured is given. Similarly, I also check what is your loan amount. So suppose I have taken 50 lakhs, 5 crore loan, then I won't give you cover equal to 5 crores. I will test your income. Based on the income only I'll give, because suppose I have taken unduly high loan and I'm owning only 3 lakhs an annum and I have taken say 30 crore loan to say set up an industry and come to you for a life cover of 30 crores, then indirectly I may even default my industry and I might get the full life cover. So life cover is never based for that kind of if that kind of a scenario, you should go for general insurance. So I have got a company, I want to insure my plant and machinery, I want to insure my factory. That is a different ball game altogether. In life cover, if you're earning person only, you get. Now, for example, I'll tell you, I retired at 60. So I took a life insurance cover at the age of 45 for 15 years. So age of 60, I retired. And at the age of 60, I thought, Array, now I have retired, I am having a lot of ailments. Can I go and take one more policy? It's not possible. Because generally, life insurance companies do not give policies to people who are not earning anymore. Nor do they give policies to people who are on the ager side. So, life insurance companies do medical underwriting, they do financial underwriting, then they do other forms of underwriting, like they assess your application form, they take medical information bureau. Nowadays, like CRISIL, medical information bureau is also coming in, where all the hospitals you have visited in the last 2 years is all stored in medical information bureau. All the doctors in the hospitals supply this information to these bureaus, and based on a check with the bureau, they can find out if you are lied. If you have lied that I have never visited a doctor in the last 12 months, they can easily find out. There are credit points, debit points given for the health status. So medical underwriting has become very sophisticated these days with correct information, so that false information given in the application form can be easily traced and the policy can be declined. Risk classification, I told you. Lowest premium, standard premium, substandard premium, or decline. I think this slide was very important. I wanted to cover. I think this is very important because the heart of a life insurance company is underwriting. There are only three departments in a life insurance company which are very critical. One is, of course, the marketing. The second is actuarial, and the third is underwriting. Marketing, chodo, every company does it, but life insurance companies have actuarial, which is the pricing, and the second is underwriting. And based on this pricing, every product that is prepared by the life insurance company is priced by the actuaries. And based on the product and features and the pricing, underwriting rules are framed. They create separate rules for each product how to underwrite. And depending on that only, the life cover is given. Again, I will reiterate, there's only one slide left, so I'll reiterate from the beginning. India is a growing economy, so insurance cover is necessary. India has got simultaneously young population coming, simultaneously aging population, so retirement products are also equally important. There are physical savings are declining, increasing financial savings are declining, whereas it should be the other way around. Loans should be covered, financial loans should be covered. People have to take more financial cover. So life insurance cover is of two types. One is traditional, another is unit linked. In traditional, you got participating, you got non-participating, and you got unit linked policies. Participating products, no guaranteed benefit, but every year the pool is assessed. Out of the profits, 95% is returned back in the form of bonus. In non-par products, guaranteed interest rate, it is a product where certainty of benefit is there. Unit linked products, investment in the stock market with a life cover. What is the difference between unit linked products and mutual fund? Mutual fund has no life cover, unit linked products have life cover. So unit linked product gives the best of both the worlds. It gives the best of both the worlds. It helps you in stock market investment indirectly. It is not exposed to the complete vagaries of the stock market. It is a very balanced approach. At the same time, you have a life cover. Pension products, you have immediate pension. You invest the money today, you start getting pension from next month. You have deferred pension. You plan from the age of 50, and from the age of 60, you start getting pension. Then there are pension products with life, joint life, return of purchase price. So these are the different types. Underwriting, I mentioned to you, medical underwriting, financial underwriting. Medical underwriting, age, health status, past condition, family history, lifetime habits. Financial underwriting, as I mentioned to you, how much loans you have taken, what is the income that you are earning. Information sources are many. Now I'll come to the last slide, which is risk management. Now, how do companies go to the next slide, Pranali? Yeah. So how do companies keep their long-term solvency? Long-term solvency, suppose you're buying a policy from a life insurance cover, or you're buying a policy for a pension product. These are all long-term policies, friends. They are not policies for 3 years or 5 years. They're all taken for 15 years, 20 years. So these companies should be solvent. They should remain solvent after that much time. So these companies have to be strong. LIC, for example, is strong for 50, 60 years. So these companies are judged by 3-4 main parameters. They are judged by profitability, like any company. They are judged by growth. Why growth is important is growth increases the pool. The larger the pool, the lower the mortality. The larger the pool, the better the estimated assumption will come true. You know statistically what happens. Statistically, assumptions are true when the size is large. The pricing assumptions, the mortality assumptions, the death assumptions become true when the pool becomes large. So growing company, whether I have invested in bought a policy from a company, is my company growing? Is my company large? Is my company's profitability year after year good? Is my company's solvency ratio good? Is it solvent? And solvency ratio is very critical for life insurance companies, because the better the solvency matlab the ability to return back to the customer at any point of time the entire money. That is the solvency. Sorry. So, what are the parameters based on which companies are judged? One is profitability. Second is solvency. Third is value of new business. Value of new business, matlab the type of products sold. If the company is selling varieties of products, or is it selling only one type of product? Value of new business grows when you sell more of par products, when you sell more of participating products, when you sell more of pure protection products, pure protection is pure life cover products, the solvency grows, the value of new business grows. So value of new business, profitability, solvency. Fourth is persistency. Persistency matlab, how many customers are continuing their policy? Continuing the policy, I took a regular premium policy for 15 years. After 3 premiums, I dropped it. I didn't continue my premium. So are the life insurance companies policies continuing? How much percentage of the life insurance policies are persistent? Persistent means how many customers are paying renewal premium? You must have got renewal premium reminders from LIC or anywhere. How regular I am in paying regular premium? So as a life insurance company, if you go as an auditor to a life insurance company or you're an investor in a life insurance company, you should look at profitability, growth, the size of the company. Fourth is you must look at solvency. You must look at persistency. Persistency matlab how much premium policies are continuing. And the sixth you must look at is what is the death claim ratio. Is the company death claim higher or lower? If it is higher, that means lot of sick people have somehow managed to get into the pool, which means this company will go insolvent. So what is the death claim ratio? And most important, how many claims they are paying? If they are not paying too many claims, let me tell you friends, that means reputation is at stake. So one, you must pay 99% of the claims given. At the same time, your claim ratio should not be away from the pricing ratio. If I priced assuming death will be say 1 in 1000 and death is say 5 in 1000, then that means you're losing. So I'll come to non-financial parameters here. Financial, I told you, profitability, value of new business, price, death claim ratio, then claim assumption versus actuals, claim paid ratio. These are some of the financial parameters. More important here is process integrity and compliance, ISO standards, quality accreditation. Very important, friends. If the process is not integrated, underwriting processes, the claim processes, the overall new business capture processes. So the process integrity, the consistency of the processes, the compliance, the marketing process, what is the mis-selling ratio of the company? Are salesmen selling properly, transparently the products? What is the complaint ratio? All these are properly, how many parameters this company is assessing every day. The process integrity and compliance, ISO standards, quality accreditation. You must see the quality accreditation. I must have mentioned in my profile that I got my company to win the Ramakrishna Bajaj National Quality Award. Why this award is important? Because this award is a wholesome understanding of about 6 major parameters of the company: leadership, products, marketing, process, technology, CSR, and sustainability. HR, 7. So it is all-round assessment of the company's strategic perspectives. Second is customer selection. Do I select all old customers or this company selects customers across all age bands? If I'm selecting customers across all age bands, it's a healthy company. If my customer base is all old customers, 60, 55 plus, then likelihood is the mortality will be high, the death rates will be high, and therefore the premium of this company will be higher than other companies. Let us say LIC, LIC is the wrong example to give. Any life insurance company is majority age band is 50 plus. And some other company, like say private company, age band is say 25 plus. This company's premium rates will be lower than the other company because their risk is lower. Third is persistency. I mentioned to you, policy continuity. Fourth is mortality assumption. What is the death rate assumption versus actual? And in annuity policy, is reverse. What is the longevity assumption versus the actual? It is too early to say. Annuity products are recent origin. They have come very recently into market. So very early days to say whether annuity longevity selected is higher or lower. Then mis-selling ratios and reputational risk. Reputational risk also includes the sales process, whether the sales process has integrity, ethics, value systems, and technology. Any data leak will actually impact the company. Any data leak will impact the company because data leak or cyber hacking, these all impact the technology of the company, maybe leak customer data, maybe create customer scare. So technology modernization, how much of artificial intelligence you are using, how much of modern technology you are using, what is their data servers, and how many critical incidents of technology breach has happened. So these things also have a reputational risk on the company. So when there is reputational risk, what will happen? Lesser customers will come. Lesser customers come, the pool will become less. The pool becomes less, the mortality will grow. If the mortality grows, premiums will become higher. So all cyclical, it's all interconnected. The companies which are growing, which are large, where the pool is increasing and profitable are the good companies. Does it mean a new company which has no base cannot come? They can come, but the growth should be there. Constantly it should grow. So sales process, technology process, mis-selling ratio, complaint settlement ratio, these are all reputation. And the last one is sustainability. Sustainability is not only about CSR, it is also about how we are coping with changes in the industry. Industry may come with new regulations, or there may be regulatory changes which may. So, for example, a company is dependent on only agency channel, and growth is happening in bank assurance channel. If the company is not coping with the channel, then they may lose out. Or if a company is very dependent on bank assurance, which is where the bank sells, and tomorrow regulator says that you cannot sell more than 50% of your products through bank assurance channel, whereas now you are selling say 95% of the products, what will happen? This company will have difficulties going forward because they have not prepared themselves. So any lopsided product mix, any lopsided channel mix, any lopsided customer mix will impact the company, because regulatory changes may come saying that actuarial standards may be reset, pricing standards may be reset. So regulatory changes, preparedness for regulatory change is also a measure of sustainability. And I think I've come to the end of my presentation. I have covered profitability, risk management, types of products, various types of channels, various types of products. I think underwriting standards. Wholesomely, I have covered the life insurance industry to the best of my knowledge and understanding. I throw open for questions. You can post your questions in the chat box, and I can take questions. Yes.
Now I request all the delegates to unmute yourselves and ask questions if you have. You can also put your questions in the chat box.
I'll be happy if you put it in your chat box because it's easy to handle because multiple voices.
Hello.
Yes.
Hello, sir. Hello, Ravi, sir. How are you?
No, sir, doubt है.
How are you, sir?
I am fine. Tell me.
Sir, doubt है. Hello.
हाँ बोलिए.
Sir, doubt है. सर मेरी मुट्ठी मार दो ना, बहन के लोड़े मेरी मुट्ठी मार दे, मेरे काला लोला चूसले भोसड़ी के बुड्ढे, तेरी माँ की चूत, बहन के लोले तेरी माँ की चूत.
Boss, it is better to mute and put in the chat box only.
Hello. I have a doubt, sir. Ravi, sir.
Yes.
Sir. Sir, takla.
See, I think you mute Pranali. Ask them to put it only in the chat box.
ऐसा sir, ऐसा
Yes, so one second.
You
Yes,
mute
I'm
everybody,
doing it, sir.
and whoever has doubts can put it only in the chat box. He'll answer only meaningful questions.
चाटा मारूंगा ना. साले
So
Okay,
there's a question in the chat box.
yeah, I'll answer that. Which agencies are good in the market to provide annuity products? Which
Yes.
agencies? Matlab, generally, you can go to any life insurance company which is offering annuity products. There is no specific agency I can recommend. Established life insurance companies is better because you're choosing a company which has got, say, 25, 30 years of existence. So basically, life insurance companies must be big enough because they must survive for the next 25 years. Assuming you are taking a policy at 50 years or 55 years, you want to live, you will live for, say, 25, 30 years. So better to go for companies which are large because they will definitely survive through the 25, 30 years. Any other question? And when you choose life annuity products, try to choose products which are to your needs. As I told you, you can choose products. If you're entering the age of 50, try to post regular premium and go for a deferred insurance product. And try to tie up your insurance product to a rate of interest because interest rates will drop. So it's better to tie it up right now so that even if the interest rates drop, you'll get the benefit of the frozen rate of interest. Please put your questions only in the chat board because unmuting has got some very unholy issues. We saw how people are misusing the unmute concept. So better thing is you whatever questions you want, you can put it on chat bot on the chat box. Yeah, somebody is typing something. Let me see what is put in. At age 65 life cover policy, sorry. Nobody in the market offers a life cover policy. We are too late. And that is why I mentioned that your children, anybody should take life cover policies as early as possible and when you are healthy. For example, I'll tell you my own case. I took a policy at 45 and I live in the industry. Look how we misunderstand our thing. I took a policy only for 15 years. That product I was capable of taking a policy for 20 years, which means up to 65 I could have covered. What happened is I took a policy when I was healthy, but at 50 I had some health issues. And therefore at 60 when I retired, I found that my product had ended because it was a 15-year product. It ended at 60 and suddenly I felt I should have taken at 45 a 20-year policy because I would have at least covered myself till 65 years. I would have at least covered my policy. So always the thumb rule in insurance is buy when you don't need it. So with so many private companies coming, I don't think in India in the last 50, 60 years, any annuity or pension plan, any private company or public company has closed down. I think so. It is also for banks. I think you can be rest assured that I think regulatorily the solvency ratios are so tight. It's very difficult for very weak companies to enter this market. And if the company's financials are very tightly monitored by regulators, let me tell you one thing, life insurance is a very conservative industry. The balance sheets are very conservative, the profitability arrived at is very conservative, and regulator oversight on the companies is very, very high. So, because people's money savings are involved for so many years 25 years, 30 years, all the more reason regulators are very, very careful about the industry. And therefore, you can be rest assured, I think, that these kind of fears may not happen. You will not have any problems. I think we should trust the regulation in the country because there is life insurance industry has been there for last 25 years. No company has folded up. And even companies at that, if the companies become a little weak, they will be merged with stronger companies. So I don't think that problem will be there.
So there is one more question in the chat box that with so many private companies coming in.
That is the question I answered just now.
Okay.
I answered that question only. There is no need to have
if
that.
If you have any questions, please put your questions in the chat box, everyone. So I see there is no questions anymore, sir. So we are going ahead.
Yeah, I only want to ask one thing. I hope my session has been clear. We are discussing some abstract subjects because all of you are not familiar with the industry. I hope I have covered all the aspects and you have reasonably understood both the products as a customer and as an investor, what to look at, or as an auditor, what to look at when you understand this sector, when you understand this life insurance company, or you go through an investor presentation of a life insurance company. I hope you got a good idea about it. Thank you very much for your understanding and patience.
Yes, sir. You want to say anything?
I only want to say one more thing, that I work for this industry for the last 20 years, been a very satisfying industry. I have understood very closely from inside how conservative we are to save, to keep the customers' money safe, to protect the families of the disease, how careful we are to pay as many claims. We are very careful not to decline claims, or at least from my experience of the life insurance company where I was working with, claim ratio, the claim admission ratio, reputation ratio is very, very less. Very rarely we repudiate claims unless, and those claims are also repudiated if there are huge malafides, misrepresentation of health, wrong representation of health. Otherwise, it is generally paid. So generally, this industry is a good industry, both to work for as well as to buy policies. And also as an investor, it is a safe industry. You will not get very high returns, but it is a safe industry.
So we are going ahead. Before that, on behalf of ICS and all the participants, I would like to extend our heartfelt thanks to you, sir, for your valuable session on the topic insurance industry during today's Sadguru. Your insightful thoughts, rich industry experience, and practical perspectives made session highly informative and engaging for everyone present. The knowledge and guidance shared by you were truly inspiring and grateful, appreciated by all the participants. We are grateful for your valuable time, support, and contribution towards making the session successful. Thank you once again, sir.
I am also a volunteer with, I am a trustee with Karuna Seva trust doing a lot of work in the social sector. I would request Pranali to show a small video of the work that Karuna Seva is doing.
Yes,
and request you people to appreciate. You can even come and work with us. You can actually do Seva along with us. You can contribute. Just show the video once, Pranali.
Yes. Okay.
A very small video, just 2 minutes. Kindly stay back.
टाटा कैंसर हॉस्पिटल और KEM करुणा सेवा ट्रस्ट करुणा सेवा ट्रस्ट हर रविवार टाटा कैंसर हॉस्पिटल और KEM हॉस्पिटल में कैंसर मरीजों और उनके परिवारों को निःशुल्क भोजन सेवा प्रदान करता है। कई परिवार दूर दूर से इलाज के लिए आते हैं और कठिन परिस्थितियों का सामना करते हैं। आपका छोटा सा सहयोग किसी भूखे चेहरे पर मुस्कान ला सकता है। आइए इस सेवा का हिस्सा बने, दान करें और मानवता की इस पहल को आगे बढ़ाएं।
Yeah, so friends, we do average every Sunday morning we serve more than 3,000 people a wholesome brunch, 7-course breakfast to all the people who come from very far away lands for treatment in KEM or Tata Cancer Hospital, and each plate roughly crosses about 125 rupees. And every Sunday we do that. I would request you to contribute to us maybe 3 plates, 4 plates, 5 plates every week. Even if you contribute 5 plates, that will be about 500 rupees. And every week, if you do it, I think you can get a feeling every Sunday when you have your breakfast that yes, I gave 500 rupees for some worthy person. I would, and we are going to expand our activities also. Recently in Maharashtra, we had supplied, when there was heavy rain, we gave blankets to a lot of people in the villages. Pranali, can you share in the chat box, she has shared the account number and the details of the trust. Kindly give us your hands, your shoulders, and help us to grow with you, with your support. This is a completely NGO. You get Section 80G benefit. And my request to all of you is help me in this endeavor with your contribution. And do call me over my phone, or you can share my phone number here, Pranali, so that you can get in touch with me and seek any further details you want about the trust. Or you can get in touch with ICS. They will guide you to me, and I can give you any further details. But even micro contribution by you every week, when you have your lunch or breakfast, you can think of 2 individuals there and contribute 250 rupees. As good every week you can think of. So it is something. And if you are in Bombay, you can get in touch with me. You can come to the place and even serve yourself. You can serve with us, and you can get the bhavna of actual serving. Thank you very much.
So yeah, we are going ahead. So ICS is pleased to provide you all its research and development, integrated management system, QMS, EMS and OHSMS, excellence in education management, ISO made easy in Gujarati, Marathi, Telugu and Hindi. Our recent publications, first one is Urja, Thermal, Oil and Gas Nuclear, and second one is Junk Se Junk Tak, Fight with Rust, Corrosion Causes and its Mitigation. For reading any of the above books, please contact Ms. Sushma Kindlekar. Feedback form. Please register on www.sadgunsang.org and go in your login and give feedback. Before closing the session, I would also like to thank all our participants for their valuable time and active participation. We hope you found this session informative and useful. Have a nice day.
Can I log out?
Yes, sir.